stepped down May last year.
Just under a year ago.
Did you start laying the groundwork for this Uber deal here at the NYSE?
For years. In Davos, maybe 4 years ago, we were trying to figure out how we could really get in well with the company, and Travis asked for an introduction to Jack Ma, actually, speaking of Alibaba. So that was kind of the first way we were able to start to build a relationship. And then when Dara came in, I went and I met with him around about a year ago. It was actually even further when he had just started. And man, I liked him from the get-go. Just a simple, humble guy. He had a plan. He met me himself at the elevator bank. We scheduled a half hour. We spent an hour. He told me, we're not doing an IPO in 2018. We'll likely do one in 2019. This is how we think about the business. And here they are today.
So you get some credit.
No, I don't get credit. In fact, I just saw Stacey Cunningham, and I told her what a fabulous job she did. Look, 19 of the 20 biggest IPOs ever have been here at the NYSE, so they should win quite a few. But Stacey and John Tuttle did a really great job.
Video of Stacey walking with Dara Khosrowshahi moments ago. What do you think, Tom, about the conservative approach? Pricing at the low end of the range, right at the level or a little below the level of the last private funding round. Good idea?
Yeah, let me answer it two ways. First, this period right now is the beating heart of capitalism. Forget last night when they picked the share price using kind of some voodoo. This is true price discovery. This is where supply meets demand. This is going to be fun to watch. I was almost late because I was at home watching this, and I was riveted watching your coverage today. So this is very exciting. With respect to how they priced it, look, I have strong views. IPOs often have a very, very big pop, and that's celebrated. I don't think it's a good thing. I listened closely to Andrew Ross Sorkin's great interview this morning of Dara, and Dara said the right things. Two points. One, let's have a smooth price after the open. That's what I'm looking for. Let's have a smooth price. Two, let's not have a huge pop, but let's not have it go down. Let's have a small amount of positive price movement so the investors who took a little risk last night make some money, but not too much. So that's what we're looking for. If they priced it too conservatively, that's a problem, and they've just handed money away, and that's very, very expensive cost of capital.
Well, I wonder, since we have other recent examples, in general, do you think IPOs have a bigger first-day pop at the NASDAQ?
No, I don't think that's the issue. When I was selling against the NASDAQ, the issue I would have come back with, I would have said, look, IPOs tend to have less volatility at the NYSE. But with respect to the pop, there's not data to support that exact point. But there's a more recent example, which is direct listings. There is zero pop. And one of the things I said to Dara when I met with him a year and a half ago is I said, hey, I'm working quietly on this thing called a direct listing. Maybe you should consider that. And he said, look, Tom, maybe we will, but we're a capital-consuming business model at this point, and we're not going to miss a lot of opportunities to raise money, even if it's a little more expensive than I would otherwise like. Again, true to his word, he's raising money for that exact reason. But the Uber that comes to market 4 or 5 years from now, I think that may well be a direct listing.
All right, so Tom, speak to us about what you think may have gone wrong with Lyft, what went wrong with Facebook, and what obviously, at least for now, is going right now.
Well, you all have said it on the air, and you've said it yourself, Jim. First thing you want to do to ensure a good IPO is get the stock in the hands of the right investors. And I think if you saw the list of the original Lyft investors, you'd say, wow, there's a lot of very fast-moving traders. There's a lot of hedge funds that'll move in and out of a stock quickly. They knew there was positive momentum, and they thought they could get a first-day trade, and so you had a lot of sellers after that first-day trade. The second thing, and this is what's going on right now, the team leading this price discovery process is Morgan Stanley. The quarterback of that process is actually a quarterback. John Pacey played for the New York Jets in the preseason, was a college star. He's leading that process back in Midtown, opening the stock at this moment. If they have a sense that this is going to be another lift, in other words, they're going to open it at a price, but then there's going to be a vacuum below, there's a lot of tricks of the trade that they can pull over the next 3-4 hours to really try to milk that opening price down. And that's what I expect to see. They don't want to see a 30-40% pop here, ideally, because it's going to open the comparison door to Lyft, and it's going to get people quite a bit concerned.
Speaking of Lyft, Dara talked about it earlier this morning with Andrew Ross Sorkin on Squawk Box.
I think that there's no perfect lesson here. I think that they probably did the best they could with the data that they had. It led us to be a bit more conservative, and it did lead us to place with mutual funds that we trusted, with whom I've had relationships with the past, etc. But again, all of this, when you're in the middle of it, it's very easy to second guess it 2 weeks later. But when you're in the middle of it, you do your best. And I think they did their best at the time.
Hey, Jim, he could have easily punted on that answer, and he didn't.
No, he didn't. He's so straightforward on everything. That was such a natural say, listen, that's not my deal. I don't want to know that. But I do think that I'm looking at this. Look, I'll be candid. It's a little more subdued than I thought. I mean, I would have thought there would have been a 50-52 to get started. And this is, if you're at home, I think you might be saying, obviously people are at work now, hey, if they had told me it was going to be 45-46, I would have come in and bought some. I think that this is a keepsake name. I think there are a lot of people who feel that this is a revolutionary keepsake, and they would like to have a couple hundred shares.
Perhaps. Tom, I'd love to come back to you on the book itself. I spoke to Nelson Chai, the CFO of the company, a bit about that. You referenced Alibaba when you first sat down here, and I remember distinctly Joe Tsai went through, I think, every single name virtually who was going to potentially be a buyer of that stock. Nelson has intimated similar sort of focus on the names. How important is that?
Well, and all three IPOs had very, very different strategies. So if you go back to Alibaba, they actually cared relatively less about the pop. And in fact, the stock opened right here at 92.70, I believe was the final number. Closed that day at 93.10. But they priced it the night before at $66.
Right.
So they actually gave away $10 billion worth of value straight to the buy side. Why were they willing to do that? Because they got what they considered the perfect allocation of very long-term holders. And true to form, that stock traded dead smooth, if you recall.
Never gave it up.
Exactly. Whereas in the Lyft IPO, I suspect what you saw was a little bit more of an emphasis on let's go ahead and get a nice price and get a little bit of a lofty elevation. I think Uber is striking the right balance between the two. What I expect to see today is a stock that trades up, but not too much, just like Dara said, and it's going to be in the hands of the right guys.
What do you say to people who wonder whether Uber waited too long to go public? You know, where in the life cycle a company should be? They waited a decade. Of course, ironically, they go public on the worst week for stocks of 2019. And, you know, revenue growth, that flashy revenue growth, has declined a little bit because they're just so large.
Well, they did. They waited too long to go public. I mean, in my mind, it's manifest. The arguments on that side of the ledger are myriad. Some of the issues they had, I'll call it culture, some of the issues they had with their culture would have been solved in a public market. You wouldn't show up on a quarterly conference call every quarter and have 3 or 4 news stories like they were having for 18 straight months. Secondly, the returns for Uber investors haven't really been that good lately. I mean, you look at all the money invested in Uber, $25 billion. Their pre-money valuation last night was 73. This is a 2.8x investment. That's great and all, but the initial investors got 10,000 times their money. So the recent people, they haven't been making money. This is a company that has needed public discipline. This is a company that has needed a public currency, and it's a company that should have gone public 3 or 4 years ago.
Did they ever explain why they were so patient, too patient in your view?
They did explain why, and I disagreed with the reasons. It was, hey, we're in a land grab. We don't have time for that. The public markets aren't going to allow us to do it. But look at the foray into China. There was a lot of money lit on fire in that foray, and if they were showing up on a quarterly conference call, remember what happened to Facebook in their first earnings release? They showed up and said, oh, we don't have a mobile strategy.
Yeah, we were talking.
Yeah, that was
the stock
suboptimal.
Yeah. The stock tanked, and then what happened? They built a mobile strategy, and they ate the world.
They had in that conference call, they talked about a couple of clients that no one had ever heard of. It was really just it's a furniture company somewhere. And the idea that there are lockups is a long-standing tradition, and yet we kept hearing that there was no real great lockup experience with Lyft. How's that possible?
I personally don't think it's a big deal. That's me. There's a long-standing tradition of lockups. Typically, let's say it's 6 months. The problem you otherwise would have had on IPO day, you're deferring 6 months. In my view, if your investors don't want to hold your stock, why are you going to hold them captive? And the example I'll give for you is Spotify. Do you guys remember on the day of that direct listing how smooth that traded? There were no lockups other than I think Daniel Ek came out and said, I will not sell. So he self-imposed lockup. So I personally don't think lockups are a tremendous part of the price discovery on day one, Jim, but the data is mixed.